Dan Lacalle, who's chief economist at Crédit Gestion. Dan, nice to see you as ever. Look, lots of factors going on in the world, lots of things going on in China. Let's start off on China. If we take away what is happening at the moment about COVID protests, what is your view of China for next year, regardless of what we're seeing at the moment with these protests across the country?
Good morning, Steve. I think that the challenge for China obviously comes from not just the protests and the slowdown of the economy, but the real estate sector. However, if you strip out the real estate sector, which is certainly going to continue to be very weak in 2023, the reality is that the technology sector, the services sector even, is likely to show a much better performance in 2023, certainly than 2022, because we have behind the lackluster profits that have just been published. Industrial profits are likely to continue to be relatively weak. However, we cannot forget that in China, while we speak, there are sectors that are growing 20-25% and that will continue to do so. So I think that investors need to take a long-term view and be very diligent about deciding which sectors to invest in China. It's not going to be a year of looking at an index. It's not going to be a year of looking at being passive as an investor, but looking at active opportunities in sectors that are certainly going to continue to be very strong. And I think that tech is one of them.
Have we underestimated the effect that China and the ultimate direction of its economy is having on the rest of the world? Because, of course, when we had this huge growth phase with double-digit growth in China, I think we almost started taking for granted it was providing the X factor on global growth as well. Are we underestimating the negative effect it could have on the broader global economy?
I think we are. I think that we thought that the slowdown in China was not going to have a ripple effect on the rest of the world economy. I think it is very evident in Germany, for example, with exports and with so many other economies in Latin America as well, not just from an export perspective, but also from the perspective of financing of investment projects. The slowdown in China is much more significant and has a negative effect on the global economy. So if we can say that in 2018 to 2020, China provided a multiplier effect on the global economy, what we can certainly say is that in these years of slowdown, it is generating a dividing effect. However, we cannot forget that in the Eurozone and in developed economies, the slowdown in China is working to a certain extent as a stimulus, because if you think about it, much lower consumption of commodities from China is helping developed economies maybe pass slightly close to recession, but not in recession. So that is also, let's say, an unexpected positive, but certainly does not even start to offset the negatives generated in trade, generated in exports globally, and certainly also in financing of emerging economies.
Daniel, I want to pick up on the commodity story, though, because we've been debating the ramifications for oil. We've been so fixated on the supply side for so long now with the war in Ukraine and various different sanctions going up. But do you think we're now at a crossroads as we watch the story unfold around China?
Yes, I think we are. I think that we talked all year about supply challenges, about the difficulties of getting oil. Likelihood of that generating a big increase in prices, and what we're seeing right now is the negative effect, which is weakening of demand. The weakening of demand is global, but obviously China, being the largest importer and the marginal buyer of barrels in times of strength, is certainly impacting oil prices short term. However, if we look at the longer term picture for oil, the problem is the same, is underinvestment. Capex is very, very low. This is the first time in at least 30 years that we have seen prices go up in the year so far, and companies are not investing more. So there's a big risk in terms of supply once China resumes activity and once the global economy starts to recover in a more robust way. But right now, everything is about demand, and demand is weakening, and it's probably going to weaken further.
Dan, this is exactly what central banks have been looking for, that demand weakening picture as they increase interest rates to tackle inflation. We've had markets very closely watching for any sign that the hawks may be letting go of some of that hawkish jawboning we've seen in recent weeks. What do you think as we count down to the Fed? Are we going to see the market sedated, I guess, by some of the hawks still, or do you think we're still going to get some dovish messages coming through? How do we weigh up the messaging?
I think that we need to look at the message, and you're absolutely right, Karen. I think we need to look at the messages very carefully, because the next piece of data coming from inflation in the United States is going to be absolutely critical. And what we need to look at is core inflation, not headline inflation. Central banks don't pay attention to headline inflation as much as we sometimes think. And the dovish message is probably likely to be coming only if core inflation starts to come down, which is an absolutely essential element to understand whether the rate hikes are actually working or whether there's a need to accelerate. I believe that what central banks are going to do is start to look at the data and see the lagging effect of monetary policy. Rate hikes have worked. Rate hikes have certainly worked. We have seen commodities U-turn and round trip since June in many countries. We have seen a lower demand for credit. That is certainly what central banks are looking for, but it's not enough to curb inflation the way that they're looking at, because they're looking to curb inflation back to normalized levels, which is 2%. And even the OECD is looking at estimates of global inflation and the US inflation that are twice the levels that central banks would think are acceptable, even in 2024. So, I think that central banks, what they're probably going to say is that they're going to maintain the pace of rate hikes, that quantitative tightening is going to be done selectively and more prudently than probably should be done, but that's another question. And definitely what I think is that if that is the message sent by central banks in the next couple of meetings, investors are likely to breathe a little bit and take a little bit more risk, but prudently.
Dan, why are people buying European equities, given the backdrop that you suggest running into 2023 is going to be fairly bleak? Are they walking into a trap, or are they seeing something that maybe we're missing?
Hi, Jeff. I think that buying European equities is a big trap in this moment, because think about this. So far, the earnings season in the United States has not been that bad, has been decent. The earnings season in the European Union has been extremely poor, but the guidance is even more concerning. And one cannot expect a weakening of the German economy, of the French economy, of the extent that everybody is expecting, plus very subdued earnings and low guidance, and expect multiple expansion. And the risk is that a lot of investors are betting on the ECB being too dovish as a multiple expansion bet. But that is not what, in my opinion, is going to work, for a very simple reason. In order to get multiple expansion in Europe, you need massive multiple expansion in the United States. And on top of that, you need not just the ECB to be relatively dovish, you need it to be extremely dovish, i.e. you would need it to be doing quantitative easing, not moderate tightening. And if in 2023, as they are going to do, the pace of the anti-fragmentation measures reduces and you start to see bond yields continue to go up, it's going to be very, very difficult to justify the valuations of European equities with a trend of profits that was already weak, let's remember, before COVID in 2019.
Dan, something that we've been puzzling about is just whether the professional investment community are on the right side of this trade. And if you look at the short interest at the moment, the charts will tell you that we've got the lowest short interest since 2000 at this stage. Does that indicate that a lot of the professional investing community are not quite convinced with the depth of the recession and the earnings recession that you're talking about?
I do believe so. I think that the majority of the trading profession has only lived expansionary policies, have only lived in the last 2 decades, central banks being extremely dovish or significantly more dovish than expected. So by default, it has always been a good bet to buy the dips or be exposed to the cycle because central banks would accompany in that scenario. However, with persistent inflation, that trade might be very dangerous. And I think that the market is giving us opportunities when there's a bounce to reduce exposure to cyclicals and to reduce exposure to those companies that demand multiple expansion and very high levels of liquidity in order to continue to go up in the market. And we must remember that this was the first year in at least 50 years in which bonds have also underperformed massively and had one of the worst years. So the big problem is to believe one thing and the opposite. On the one hand, that bond yields are going to continue to go up, and that means that bond performance is going to be weak, and at the same time expect central banks to be dovish. So I think that from the perspective of investors, taking the view that one has to bet on central banks not doing what they have said that they would do. At the beginning of 2022, at least we could debate whether they were going to do something. Now we know the pace of what they are going to do, and they're sticking to it. So if there was a mistake in 2022, was not looking at what central banks were going to do and following it, but believing that they would not do it. And I think that in 2023, we cannot expect central banks to be going round tripping on their policy. This is not going to be a 2018 situation in which you go from quantitative tightening to quantitative easing in 6 months.
Dan, thank you very much for joining us today. Daniel Lacalle with us, Chief Economist at Treasury Gestion.